Hello, hello. All right, you can hear me. All right, well, we appreciate the few who have stayed to the end. Good to see you. My name is Pat O'Meara, and I was told that there is no introduction. I'm just supposed to stand up here and start speaking. So here it is. And my topic is real-world assets and tokenization of them, and what do we mean by that? And I'm the chairman and CEO of Inveniam Capital Partners. It's great to be with you. And the first thing that I want to do is I want to talk about the fact that we need to speak with precision, because people are using terms all the time in really incorrect ways where you can have two completely different functions and meanings of using the same term when you're speaking. And I want to distinguish what we mean when we're talking about real-world assets trading, because I think there's kind of 5 different things that people talk about, right? Real-world assets trading in a tokenized form can mean the first distinction that you make is, are you pulling data from a referenceable database of something that exists with ready available data for it? So a tokenized treasury or a tokenized share of Apple. All of that data is sitting in a database, easy to see, and you're tokenizing that and you're trading it, and that's an easy thing to have, right? Tokenized treasury, money market funds, et cetera. So when you think about that, that is one flavor of tokenized real-world assets. Then there's another flavor of real-world assets where you're pulling data from the edge where the data does not sit in a database, right? So that is a centralized database. So it's not an Emma, it's not an Edgar, et cetera. And what we're talking about there is tokenized treasuries, or not tokenized treasuries, excuse me, tokenized alternatives, real-world assets, and that's where we're talking about things like real estate, and we're talking about private credit and private equity and infrastructure. And we're talking about them where we're talking about funds and where we're talking about the capital stack of individual assets. And each of these have nuances that matter, right? And I think that anybody who is not speaking with precision when we're talking about what we mean when we say we're going to trade real-world assets, that you can slip into the platitude and the meaningless really quickly. Do you know what I mean? And so what we need to do is talk about in Inveniam, we're focused on trading of data-rich, low-frequency trading assets where data exists at the edge and it's not in one centralized database. And as we think about the trading of private credit, private equity, real estate, infrastructure, we need to think about this in a tokenized form where there's a decentralized marketplace per se. And I want to talk about 3 things. A decentralized ledger presumes in a decentralized marketplace that there's also compute. And that compute needs to be decentralized as well. And we're going to talk about what we mean by that. And then we're going to talk about data. And if you centralize any of those 3 functions, if you centralize the ledger, you're going to have intermediaries who are rent seekers who are going to charge you money for it. And the whole promise of a decentralized marketplace will not come about, right? Compute. If all compute has to be confined to one location or one function, again, there's going to be a centralization, and the promise of a decentralized marketplace will not happen. And that's the same thing with data. And so what we want to talk about is, what does a truly decentralized marketplace mean when we have data, compute, and ledger functioning at the highest possible manner in a fully decentralized way? And I want to start by talking about the difference between private markets and public markets, where we're just talking about compute. Because in public markets, it really is a centralized ledger. We know that, right? The advantage of the centralized ledger and a centralized data repository, Edgar, is that compute can be pushed into that data set at scale, right? High frequency trading, compute, brings enormous liquidity, and some could even argue that there's been too much compute put into the public markets. Does that make sense? Because what it does, it will actually swing the market beyond the fundamentals of the underlying. Does that make sense? Where it's utilizing the data. Now, when we have compute that's going to be pushing at scale into other markets, like private markets, that's when we're going to see in the early years the real benefits of enhanced liquidity by improved data. And then we're going to see this illiquidity premium be distinguished from a discount for lack of marketable information, right? Because many times there's two things that are in play, right? When we're talking about illiquid assets trading, and there's an illiquidity premium or discount. And what we do there is we say in many times that there's an illiquidity discount, and what is really at play is a discount for a lack of marketable information. Does that make sense? We conflate the two, and we talk about that all the time. There's not very good data, and we call that an illiquidity premium. Those are two different things. And what we need to do is begin to understand the distinction between those. And so Inveniam is this connective tissue between data at the edge, compute, and ledger, right? And we know we're not going to go from a fully centralized world to a decentralized world overnight. But the movement to decentralization is happening in each and every one of these sectors. And let's just talk about compute broadly. And I know that there's some people in computer science who hate when I just talk about compute broadly, but remember where I was criticizing other people for imprecise language? I'm going to use that as a crutch right now, right? And so compute, when we talk about decentralization, the movement to the cloud is a first fundamental movement of compute being decentralized, as well as SaaS. And any kind of thin function where you have massive compute at the edge and you have a thin, meaning the compute is not on your laptop, right? And you've got a thin device that you're reaching into compute at the edge or in a centralized repository. That is a move to a decentralized compute functionality. So SaaS as an entire industry and model has pushed us there. And what I want to talk about is we are seeing massive evolution in compute right now, in AI, in machine language, in robotic process automation, right? So those three things are there, and it's going to bring an enormous amount of compute functionality to private markets. But if it doesn't have attributable data and data that you can actually audit and see where it came from, it's meaningless. Does that make sense? Now, the next step is, what is that thing that it's informing? And it could inform a financial instrument on a centralized ledger, that's for sure, right? But if it's informing a financial instrument on a decentralized ledger that allows an instrument that represents a piece of the equity of a multifamily housing portfolio, and you have the ability to real-time process that data, pull that data, compare that data so you can price the gross asset value of the asset, you can run a waterfall, you can figure out a carry calculation, then you can price the capital stack. If I can store that value in the piece of the capital stack and in real time understand its value and then allow it to trade 15 minutes a day or once a week or once a month instead of once every 7 years, suddenly what I'm doing is I'm dramatically changing the discount for a lack of marketable information. And there's a bunch of people who've written many, many great papers on this, right? Nobel Prizes have been won as they dive into understanding this. And the example that I'm going to give is discount for lack of marketable information is if I own a building in Manhattan on 5th Avenue and I don't have good information on that building, because it's within a robust market, there might be a 5 to 10% denigration of the value of that asset. Does that make sense? But if I own an asset in Kuala Lumpur and I can't prove the performance data of that asset, nobody will bid on it. Does that make sense? The market, the broader market for that geography is limited enough that the discount for lack of marketable information is huge. And what we see in real estate right now, and we see in private equity, and we see in private credit, and in infrastructure, we could talk about that at length, is the longest part of the trade, and I got this from Albert, a great analogy, the longest part of the trade is always the denominator for the speed of a transaction, right? So figure out what all the steps are. What is the hardest one? That will forever and always denominate the speed by which that asset class trades. Does that make sense? And in real estate, what is the number one item that slows down a trade? Diligence. Does that make sense? You want to know the state of your asset. Same thing with infrastructure. Same thing with private equity. And to a degree, private credit. And we'll talk about that more in a minute. And what we need to do as we think about real world assets trading, meaning the alternatives markets trading, if we can begin to have mechanisms where we're looking to the edge, data at the edge, it's sitting in the systems in which the data is collected and sits at rest. And we begin to periodically look at that. So through Inveniam, we've got about $70 billion of assets that we look and we, every night at midnight, ping and look at the state of their data. And if there's any change of state in data, what we do is we kick off a workflow. That ability to surveil data at the edge, the way we do it is we run a SHA-256, an algorithm, and we put a hash in the payload of a block. And we're on 13 chains, and another couple of sprints will be on our 14th chain. And we put that in the payload of a block. And then what we do is, every time we go in at midnight, we run that SHA-256. And if they match, we know there's no change of state. If it doesn't match, we know that something's changed. And then we can kick off a workflow. And what we're doing is we're using that as a thumbprint and a timestamp, because as we go into the future and we think about smart contracts that are going to begin to automate things like capital calls and distributions. If you have a capital call or a distribution and you actually move value on an automated basis, the only guarantee you have in life is that there will be a lawsuit at some point. Does that make sense? Like somebody's going to sue someone, and the question is going to be, what was the state of data that fed this automatic computation 3 years ago? And if you cannot prove the state of data that fed that, you can't automate the process. Does that make sense? You cannot. You're going to have a human, 4 eyes, kind of check on that function, and then you're going to appeal to process instead of data. But if you can push a hash, a zero knowledge proof that's on chain, and say this is the state of data that fed this automated calculation, suddenly you're going to be able to in court prove this was the data that fed this computation. Does that make sense? But the question is, how do you look at this data at the edge? Because the reality is data is expanding at an exponential rate, right? So there's a group called Alpha 10X. I was reading their pitch deck yesterday, and Alpha 10X, in their this kind of newest fund that they're doing, they had a stat. I have no idea if it's true or not, but it caught my eye. It said that by Q4 2025, there will be 500% of the data available as there is today. I don't know if it's 500%, but it's going to be a lot more than it is today. Do you know what I mean? Every single time there's a new Tesla, you have something that's creating a terabyte of data a day. Every new Tesla that's going out in the world. Do you know what I mean? You look at Inveniam, who's stamping out chips at scale. That's a whole bunch. And if we say that the prerequisite of private market assets trading digitally is that all their data is in one centralized database, we're creating a barrier that is impossible to achieve. So we have to do away with an architecture where we say we need centralized data and we need to go to a decentralized database. So we need to say, how can we trust the data and prove synchronicity of data that's being pulled from multiple systems and being pulled into compute on demand? That's a zero knowledge proof. That's being done today, and it can be done via surveillance. So the question then is, if we're able to pull data and serve as a browser of data systems, and pull data from many systems at once, and we're going to pull it into compute, where should that compute reside? Should that compute reside on chain, or should it reside off chain, right? And the more you embed compute unique to a single chain, the more tied you are to that chain. And if that chain goes down, you're out of luck. Does that make sense? You're making a bet on a unique chain, and in a multi-chain environment, you need to say, we can't do this. So what is the kind of logic that we want to use in order to determine what belongs on chain and what belongs off chain? And so the way we think about that is in symbolic logic, right? When you're having a discussion back and forth and you want to replicate that logical discourse on paper. In symbolic logic, they talk about 4 different things, right? Operations, constants, relationships, and variables. Everything in symbolic logic goes to those 4 things. And so if we think about compute, where we're actually processing data in order to come to an economic outcome, what of those 4 things should be on-chain and what should be off-chain? What should be on-chain are relationships and variables, right? This is a variable, the number is 3, and if 3, then we distribute money to this person, and then the relationship is it goes to here. If the number is 2, it goes to this one. Relationships and variables. Does that make sense? Operations and constants, if you embed operations and constants, you damn yourself to a reliance on a chain that if that chain does not win, you lose. You're making a bet on a primacy of a chain that can cause you a reliance that you don't want to have. So if you can put operations and constants, and what do I mean by operations and what do I mean by constants, right? So a constant is a calculation that you're going to use on a consistent basis again and again. So let's say we're going to have automatic market making for real estate. So we need an automated valuation model. So we're going to use a Cushman model, or we're going to use a JLL model, or we're going to use a Houlihan-Lokey model for private equity. That would be a constant, but you want to do that calculation not on-chain. You want to do that off-chain to feed a variable. Does that make sense in a smart contract? An operation is how you go through the steps that you do pre-trade, post-trade to service a digital instrument. Does that make sense? And that should be off-chain as well. And this is also, because right now in AI, there's a big thing, right? AI can process everything better, trust the AI. And we're still in the honeymoon phase, so we love everything about AI. Do you know what I mean? But the reality is, different people have different processes for reasons, and you don't necessarily want to trust the AI process to be smarter than the process that your business has built over 20, 30, 100, 200 years, right, in order to service these instruments. AI really becomes valuable when it helps you run your process better than you trusting it to run its own process. And what do I mean by that? How do you ingest data? What is the custody of data? How do you validate that data? How do you transmit that data? How does that what are the KPIs that matter the most? Do you know what I mean? And this is where all of a sudden we're beginning to use AI to empower a process that used to be human that we can now automate. So let me give you an example. There is a public company that we did a POC with. They administer the data on about $1.3 trillion of real estate, and they do that on a quarterly basis. They put about $13 billion of real estate onto our platform in order to do a POC just to see how quickly we could process it. As they did that, and this is a very centralized company, right? Their CTO famously said to me, I've mentioned this on a podcast before, that if I'm going to do any process repeatedly, I want to begin with a green screen. Right? And I laughed out loud when he said that, right? I thought he was joking, right? Like, oh, you know, ha ha ha. And this is a CTO of a publicly traded company. And then I realized he was serious, right? He wanted to begin with a green screen. And for those of you who don't know what a green screen is, that is a screen that connects you directly to a mainframe, right? So that's pre-cloud, pre-SaaS. He's talking about state-of-the-art 1984 technology. And this is the CTO of a publicly traded company. He said, if I want to do any process repeatedly, in no way, shape, or form am I going to do anything except on my machine on something that I code myself. That's insane. Do you know what I mean? Like, there's so many things wrong with that. But we took their 13 billion of assets on our platform, and in order to process a new valuation every quarter for that 13 billion, they processed 12,000 data points. And they used it all using people in India doing 10-finger automation, looking at emails that were sent to them in a bilateral manner. The most speedy processor of that data could do 10 data points a minute. And that was when they saw an email that they'd seen 9 times before and they just saw the 10th. Does that make sense? And then they 10-finger automated that into an Excel spreadsheet. Using our tool that we plugged in another AI mechanism, it went from 10 to 40 to 200, and our next iteration is 400 data points a minute. And that person ceased being a 10-finger automator, and you know what they were? A QA function, right? They were actually using their brain and saying, here's what we're gonna do. And Inveniam, our software, is in no way, shape, or form smart enough to take data and understand what are the data points that matter and do that. But you know who is? Anthropic. You know who is? IBM Watson X. You know who is? Inception, Microsoft, OpenAI. They're doing all of this, but they're moving at the speed of light, right? Inveniam is the airbag for that Ferrari, right? We force them to say, I only process data from something that I can validate a hash on chain. So it has to slow down in order to make sure we only looked at validated, most frequent data that's being used from what's at the edge. And then we force it to give attribution to the exact spot in the document that it delivers. Why does that matter? Because what is the biggest obstacle for big compute being used in private markets? Data sits all over the place. Nobody has the ability to aggregate it, and if you do, the way you gain an economic advantage of it is you use it on the benefit of your own LPs. Does that make sense? So Collar Capital, they spend $100 million a year just aggregating data on secondary trades of private equity interests so that they have faster, better data than anybody else so they can trade on it. So if I own a piece of Sequoia 7 and I want to sell it before anybody else, I can either go hire Evercore, they'll underwrite the whole thing, do a process, and in the end, 120 to 180 days later, I'll have a bid. Collar will give me a price the next day, right? And so what happens in moments of illiquidity? Who do people go to? Collar Capital, right? Where they can do this. What happens if we no longer need a centralized database that they're spending $100 million of their own money in order to create an economic advantage for their own LPs, but we had a distributed data environment that asset owners, through a tool like Inveniam, can put Anthropic to work to extract all the data elements, structure it, and deliver it to comparative analysis tools real time. Sam Altman with OpenAI, every one of his large language models is run on a tool called Inception. Inception is owned by G42. Inception was created by a $14 billion investment by Microsoft, and a $22 billion investment from G42, and an $800 million investment from Silver Lake. It is processing power at scale. One of the largest buyers of NVIDIA chips in the world. And oh, by the way, when they couldn't get enough NVIDIA chips, you know what they did? They spent $8 billion, one of the parents, G42, spent $8 billion to buy NVIDIA's main supplier of one of their components in order to have leverage so they could get more output. Does that make sense? So this is massive compute. But if we can't give data to it, it doesn't matter. And the reality is blockchain connected to AI, an airbag on a Ferrari is really valuable if you get into a crash. An airbag on a buggy where somebody's doing 10-finger automation just doesn't matter, right? You don't need an airbag on a buggy. Administration of alts, what we refer to as real-world assets when we're talking about that are going to trade on chain. We need to understand the state of the asset, but that data is everywhere. So if we can have a browser, a decentralized data architecture where we can look in on a permissioned basis, have AI, ML, RPA tools, look at it repeatedly, that's RPA, machine language where we're processing the data, and AI understanding the quality and delivering it in a structured form into compute at scale, suddenly we have the ability to do things like price real estate assets at scale across the globe. Cushman & Wakefield is an investor in us. They're one of the largest appraisers in the world of assets. We don't think the next big step for real-world assets is going to be trading the underlying or the primary issuance of new tokens that represent the equity in real estate. That could happen. It could also happen as funds. But we think the number one benefit that you're going to see is tokenization in order to validate data at scale in order to understand pricing and price discovery, which will drive better accounting treatment, better collateralization, then derivatives, and then post-derivatives, you're going to have the trading of the underlying and secondaries, and then primary issuance. But if you don't have good price discovery and accounting treatment, you're never going to get to secondary trading. Do you know what I mean? If you don't have price discovery in there. And so what Inveniam's doing is, by the way, I had notes, but you can see I'm sticking to it. As we think about the ability for blockchain to be a mechanism through zero-knowledge proofs of AI's ability to deliver compute to data that sits all at the edge to inform an instrument of the real value of the pieces of the capital stack, it explodes the opportunity of what's really available in the markets. And you say, well, what retail investor is going to benefit from this? They're not for at least a decade. But what institutional investors are going to benefit from this? A lot. I'll use an example. CPP, Canadian Pension Plan, buys a ton of data, and they try to recreate the CPI index every single period that it's announced ahead of it. And you know what they do? They trade ahead of it. They buy the raw data, process it, and then they trade ahead of it in order to outperform. And they try to recreate CPI. You have people like, I'm going to use Saudi Aramco, Mubadala, the PIF, who are gathering enormous amounts of data. They're pushing it at compute, looking for insights so they can trade ahead of it. There's a very famous, in one of our podcasts, we talked about this 2 weeks ago, where a private equity player was looking at trends, and they typically had a 1-year free look at where everything was going before their competitors began to see the sectors that came in, because what they were doing is they were processing the data signals of what people were paying attention to and beginning to look at. And this ability to gain insight into massive amounts of data, when we can all of a sudden start to do it against an asset class, let's use real estate, is going to explode that asset class. How will it explode it? If we can price real-time real estate assets with attribution through automated valuation models and third-party marks once a month and AVMs in between, and all of a sudden we have good pricing, this creates enormous opportunities for people to create economic thesis that they can articulate in a trade well. Right now, if you have an economic thesis about real estate that you want to articulate, you have to do it through either owning the underlying or you have to own a REIT. A REIT is a super messy thing, right? That same REIT will own a cell tower, which is a fixed asset with a long-term contract, and you'll own a piece of retail in the exact same REIT, which is completely susceptible to consumer spending. Two completely uncorrelated, unrelated types of assets that are in the same thing. And oh, by the way, you've got geographic messiness because these REITs just buy what was for sale when they could do it. Now, you have people who say, I've got a much more focused REIT. Those REITs, by definition, are not good, clean mechanisms to articulate an economic thesis. But what if we can take all of the real estate data? So one of the things Inveniam is doing right now is we're working with we have one of our largest user of our software is one of the big sovereign wealth funds, and then one of these big AI companies and a couple financial intermediaries. We are working to create the world's first derivatives exchange for real estate. And we're doing it because we have the ability to get critical mass on north of $1 trillion of real estate where we got pricing data. As real estate owners say, we want to opt in to allow our building to be valued. We still control the data. It's not lost to a centralized database so they can pimp it out to somebody else. I can create indices. Those indices you can trade against. And what happens is if you own an underlying of a bunch of REITs, or you have your own real estate portfolio, but you want to hedge out a risk, you're going to be able to say, I'm going to do this through shorting New York real estate and going long Miami real estate, right? Or you want whatever the trade might be, right, that you want to do in order to articulate where you think the real estate world is going. Now, a lot of people say this is going to happen through tokenization of the underlying. We think that'll happen, but it'll happen in 5 years. Because the tokenization of the underlying is one building at a time, changing their legal structure, tokenizing those assets, putting them on the market for secondary markets, and all of a sudden then you get trading, and that trading is going to be a very accurate form of price discovery. But before that, if we can accurately get good data that's fully attributable, that we're using these new machine learning, RPA, and AI tools to extract data at the edge, deliver it in a manner that compute can process, we can create these indices. Suddenly we have the ability to create indices, and then from there, the ability to create mechanisms and puts and calls, and the ability to create all sorts of derivatives, repo markets for lending against private credit because we understand the collateral. And this starts just to open the door. It's the next step. Now, then what happens if we have these indices and people begin putting these tokens into for the equity, let's say, of a building, and that equity of a building, if it's a large enough asset or a large enough asset pool, suddenly we put that into an AMM. For full disclosure, Inveniam, we own 65% of a company creating AMMs for real world assets. If you do that and there's a third party setting the mid, and you have an AMM function for these things and they're trading, and IX Swap in Singapore has 6 of these that are live. The 7th one might have already gone live, but they're live. If you have real estate trading live every day, even if it's using an AMM, and you have attributable data that's trackable and logged, you've just met the definition for moving a real estate asset from level 3 to level 1. Forgets level 2, which is what Inveniam was preaching forever. We're moving a level 3 asset from an accounting treatment to a level 1. What does that do for an insurance company? That completely changes its capital charge. What does that do for a bank? That completely changes how much they have to reserve against those assets because they can see what's in there. Now, are 7 data points enough to go from level 3 to level 1? Probably not. But it's probably about 100. And once that happens, Deloitte will easily say, if you've tokenized a piece of your real estate or a piece of your portfolio and put it into an AMM and it's trading with daily subscriptions and weekly redemptions, that is a level 1 asset. That's going to explode and drive what people are going to do. And this is where we think data and price discovery will drive tokenization. Does that make sense? And it is the interplay of not one new technology. The market advance is going to come because we are connecting the value of a decentralized ledger with instruments that can trade in an AMM function connected to compute innovation in the form of AI that can reach into a decentralized data environment and pull it, and they don't need it all in one database. That was not possible 3 years ago. Full stop. It was not possible 3 years ago. It's possible today. That's amazing, right? And as we start thinking about what is going to happen, where you have AI with attribution able to deliver information to compute at scale. Imagine that you have a real estate asset, and there's a large enough of a data pool that you have a computer, and in this case we're going to use Inception AI, Inception from G42, they can say these are the top 85 comps for your large asset not in your MSA. That would be pretty crazy, wouldn't it? Anybody who's ever looked at an appraisal for real estate, what do? You get 6 to 8 comps in your own geography. But what happens if all of a sudden for this large asset it says this is the top comp in Kuala Lumpur. This is the top comp for that in Riyadh. This is the top comp for that in Sao Paulo. This is the top comp for that in Sydney. This is the top comp for that in Topeka, Kansas. All of a sudden, you have global financial players that are able to relate and understand the asset better. Does that make sense? And all of a sudden, their ability to invest goes up at scale. This is the opportunity for tokenized real-world assets. And now people are going to say, well, can't you do all of this on a database? Sure you can. But that has nothing to do with the innovation of a decentralized economy where you onboard and create a decentralized mechanism of innovation that blockchain brought about to do away with rent seekers and bottlenecks and rather open the door to broad spread innovation and create real open free market competition for capital to be allocated where the greatest alpha is. Does that make sense? And it's a democratization of the creation of a free market system with data symmetry. Wow, that's pretty crazy, right? When there's data asymmetry, there's 2 things you can do. Leverage the data asymmetry for your own book, or compress the asymmetry and collect rents from everybody. That's what Inveniam is trying to do, right? How do you compress data asymmetry, deliver it at scale to these big computers? And by the way, you have enormous amounts of money going into AI right now. Stupid amounts, right? Sam Altman said, I'm going to get in. I don't want to continue to build chips in the fashion AI is being, pushed by NVIDIA into one type of chipset structure. I want to create my own chips. I need $130 billion to do so. That's a lot of startup capital for an idea. One entity said, we'll put up $80 billion. That's shocking, isn't it? Right? There is money flowing into big compute at scale. The airbag of blockchain and zero knowledge proof that Inveniam is working on is to make sure that that compute is being pushed through a proof of process, through a process that people know and want to understand, and attribution of source data, so it's not hallucinating. As we can begin to grab that data from all over the world, deliver it to multiple compute functions, and then inform products like the capital stack of a portfolio. But as we're reprocessing the gross asset value of the asset, the waterfall, the carry calculation, and then running the waterfall, and every day there's a new price being set on an automated basis, that also has a tangential effect of repricing the GP's carry every day. Do you think those will be traded? Like all of the type of data that this is going to create. Private assets are going to go to become interval funds at scale, and you don't just need to be Blackstone to create one. Do you know what I mean? You're going to have third-party oracles who are going to be coming in saying, yep, I agree with these values. I'm putting this as a constant, my model up here. I'm using the Cushman & Wakefield model, the JLL model, right? Or a Green Street's AVM. And then GPs are going to say, we're going to get these 3 things. We're going to run them through the big compute. They're going to price this. We're going to have daily subscriptions, weekly redemptions. And then one of our partners is MasterCard. Literally, you're going to be able to put that multifamily housing portfolio in a tokenized form, and I'm going to be able to buy my latte with a MasterCard that's going to liquidate on a weekly basis. So I got a credit line for a percentage of the face. And if I can do that, why am I doing direct deposit of my paycheck into a bank? Like, why would I do that? Why wouldn't I do a direct deposit of my paycheck directly into a tokenized asset that increases in value and cannot be deflated, right? That's when banking gets rethought. And this is the tokenization of real-world assets. When we tie together data at the edge, compute at scale, and a ledger, and to the degree that all three are decentralized, you're going to have the greatest opportunity for the spark of massive innovation and the viral effect we all want to achieve. Does that make sense? And it is not one single technology, it's three different pieces being tied together. The ability to use decentralized data to inform compute. Compute's innovation in AI that's been blowing up the last 5 years, really the last 2 years that caught the public imagination. And then lastly, this decentralized ledger. Those instruments on the ledger, and this is what we think will happen, is, we're working on this, the world's first derivatives marketplace for real estate. That alone will transform how real estate is done in the world. This is the exact opposite of tokenizing the dollar and the treasury. Do you know what I mean? Which I'm not denigrating at all. It's just starting from a completely different place. All the data is referenceable, it's easy, it's tokenized, and really the problems I'm solving are around wallet and AML and KYC. Versus the other side, we're only dealing with QIBs, qualified institutional buyers, large institutions. We're solving data, price discovery, and discounts for lack of marketable information. And once that happens, we're going to start to see, with perfection of data, what the illiquidity premium really is. And if we can start to begin to erode that through AMM, man, that's really exciting. So we think this is the future of real-world assets, and it's not blockchain. It is blockchain plus data at the edge plus big compute being delivered on demand. And that big compute needs to be disconnected from the core of the ledger because we're going to live in a multi-chain world. Why don't I pause there, and I have one last thing that I want to do. But any questions, any comments, and I'm sorry that I just ranted for like 40 minutes. Yes, sir. Is your end market goal to create a more transparent product for an illiquid asset? That does not trade on a daily, weekly, seconds basis. Yes, but I'm going to sharpen the pencil just a little bit, right? It's providing data symmetry so that price discovery can be observable, and the relationship or correlation of assets to each other can be made possible across many markets. Because for many of these illiquid assets, the markets are silos. And one of the big goals of what we're trying to do in a decentralized environment is to aggregate liquidity across silos. And there's money in Topeka, Kansas, and there's money in Oshkosh, Wisconsin, and there's money in New York for sure, right? And there's money in Miami. But the reality is, particularly in real estate, a very local thing, the ability to aggregate that, if you're not huge, is very difficult, right? And so what we're trying to do is create that symmetry so that capital can flow more easily to. So the markets, and so one of the things is the asset owner. Inveniam is a tool by which the asset owner can make their assets data known to compute. They get to feed their data to whatever compute they want. So you don't need to be US Bank to use Anthropic. You can be a mid-sized real estate developer, right? And all of a sudden you're using all sorts of really cool compute, and then you're tokenizing it, and people can trust that data using the blockchain and all of that sources. And then you're listing it on places like Rialto and Oasis Pro Markets and Archax and InvestaX and ADDX and SDAX, and then also at some point maybe uplisting into public. But it is the listing of private market assets on many, many, many different exchanges. And we think that a derivatives market is going to be the first thing that's going to develop for alts. Because the pricing data we're going to be able to deliver at scale. And then from there you can create indices. I have a big screen that's saying time's up, but we're going to ignore that. There you go, thanks. Yes, sir.
Yeah, so how do you incentivize owners to share data, right? Like GPs are very protective because they want to basically have their different narratives, right? You want to have your narrative with the city, in order to, create like a lower sort of tax basis. You want to have your, discussion with, potential LP, maybe your lenders. So like these are all different stories that are being told by the same general partner.
Yeah, super great question, right? How do you incentivize people to share their data? Right now, listen, we're going to stick in real estate, but we could go to private equity if we want, but we're going to stick in real estate just because we're going to stay on that theme. CoStar takes people's data against their wishes and pimps it, right? You know what I mean? And that's their business model, and everybody hates them, right? What this is doing is you're giving people the ability to own their own data and then opt in to an indices, right? And with what we're building two mechanisms of incentivization, right? One, to anchor your data on chain, right? And for doing so, there's an incentivization model for that, right? That as you do so, either your valuations are free, does that make sense? Or you participate. And then the other side of that is, as you begin to create this, you are, the indices that you're building is in, you want that because A, any trading of that, you get some attribution, right? So you get paid. But B, a building that's in the New York 100 will trade more than the building that's 101. Does that make sense? And everybody's going to want to be in an indices. Does that make sense? And so it is a mechanism but it is fundamentally an opt-in data marketplace. That's right, lower cap rates, better performance, secondary markets. It unlocks all of these other functions, right? The AMM interval funds that don't need University of California to come and bail them out, right, when they price it wrong. You're absolutely right, but the macro trend is at some point there's health benefits to beeswax candles, but at some point electricity will win, right? Like electricity will get the whole island of Manhattan will one day have electricity in every building. I don't know when it will be, but it's coming, right? It's like betting against that macro trend, right? Transparency is coming, and you can elongate your business model, or you can pivot and say, I'm going to be somebody who's going to win in a more transparent marketplace. And I want to give you an example. Cushman & Wakefield, right? They're an investor in us. Whatever. Their market cap is $2.9 billion today. Moody's is $60 billion. Cushman wants to look more like Moody's, where they denominate and mark the value of assets, than to be a broker that's 100% transactional. Does that make sense? Because every time Moody's gets a new asset that they're starting to rate, what do they get? Fully recurring revenue. Their multiples are literally like 20x what Cushman's are. And so whether you're talking about S&P and IHS Markets, or a Refinitiv. Moody's, JLL, and CBRE want to look like Refinitiv in the future, not reliving that transactional. And by the way, the firms whose senior leadership is perpetuating data arbitrage are going to be fighting against a tide. Does that make sense? And they're going to lose that battle. But that, very good point. Yes, sir. Did you have a, oh, yes, sir.
Perfect segue to my question. Has Inveniam used data or provided data for the rating of an asset? Question one. Question two. Has the data ever been used for securitization?
No and no. Thank you. Yep, sorry. Has the data that Inveniam is processing right now been used for a rating or for a securitization? No, but it has been used for a sale. And so they're a very large asset, call it worth, north of $1 billion, many different buildings, whatever, it was a portfolio. We were pricing it real time, and they put it up for sale, and it transacted an arm's length transaction between two semi-related sovereign entities at exactly the price that was set on a monthly basis. And literally it transferred, and that transfer happened at exactly that price. So we are right now primarily being used to mark people's books real time and provide price discovery. Does that make sense? And then now we're going into listing funds, facilitating marks for AMM and exchanges, literally building exchanges. I'm sorry for going on ad nauseum. It was a pleasure to be with you. Thank you guys all so much.